Good morning. I'm waiting for here. First of all, I'd like to thank the people at Restream and, of course, at OBS for helping us all with this broadcast. So let's begin. It's Wednesday the 18th, and here's today's breakdown. Welcome to all of those in the Lone Star residents stuck in the freeze. And my teleprompter seems to have stuck on me for some reason. Oh, God. Yes, as treasuries continue gaining and the FOMC in yesterday's minutes promises to keep on buying, U.S. markets closed down again yesterday, only the Dow adding 0.29%. All this is bad weather in Texas is being labeled a full-fledged crisis by Bloomberg. We'll have more on that later. Meanwhile, the SEC yesterday announced it could introduce new legislation increasing transparency on short selling. Dodd-Frank in 2010 actually obliged this, but the agency never really paid attention. In economics, mortgage applications continued down, contracting by another 5% week on week. But core consumer inflation increased nicely to 1.2% month-on-month in January, alongside a 1.3% month-on-month PPI. That's up from December's 0.3. Canada, by the way, also saw an improvement in consumer inflation for January. U.S. retail sales were also increased by a whopping 5.9% month-on-month after last month's 1.8% contraction. Industrial production was up 0.9% month-on-month, and manufacturing a full percent. The dollar's reaction to yesterday's better-than-expected data was muted, hitting resistance at 91.02 and initiating what could be a pennant, signs of optimism. But that inverted red hammer is saying we've got nowhere to go. At 1:30 GMT, we'll be seeing U.S. jobless claims, housing starts, import-export, and the Philly Fed's outlook. So wait and see. Except for Italy, car registrations were all down in January throughout Europe, with construction output declining 3.7% month-on-month throughout the zone. ESMA, that's the Eurozone's markets authority, is warning clients this morning that trading based on social media information is risky, as European stock boards closed yesterday awash in red, the DAX losing 1.10%. As you can see, the slide this morning bodes a whole lot better. Reuters this morning informs us that Amsterdam is catching most of the equities fallout from the post-Brexit city of London. In January, 1/5 of the daily €40 billion market was exchanged at the AEX, compared to less than a tenth pre-Brexit. That's about $3.4 billion in OTOs so far, for example. Still ahead in Europe, some monetary speeches. The ECB's monetary meeting minutes from last week at 12:30. And 3 hours later, consumer confidence. Chinese stock markets returned to work overnight, at first rising, but they're mainly in the red this morning. Shenzhen losing 1.40%, the Hang Seng, which remained open, down 152, and the Nikkei 0.2%. According to Reuters, the culprit is investors locking in profits on what they may consider an outperforming market. The Australian dollar continues flat after a one-tick improvement in unemployment, 6.4% in January, but an equal drop in the participation rate. That's less people looking for work, as the economy added only 29,000 jobs in January. That's nearly half the month before. Manufacturing and service PMIs will be in at 10 tonight, alongside producer inflation from New Zealand. In commodities, the Brent Texas spread continues gaining, with both benchmarks well above the 60 mark, as cold weather demolishes 40% of Texas crude production, or $4 million a day. Yesterday, the API reported another 5.8 million barrel withdrawal. That's more than double what analysts had expected. Meanwhile, gold seems to have reversed its fortunes, bumping up off 1770 yesterday and leveling off this morning at 1781. Chapter 2 of Australia's high-tech war begins this morning, with Facebook simply banning Aussie news feeds rather than paying for content. Google, you'll remember, has been signing deals with outlets for its paid content. And Amazon is being sued in New York by New York's Attorney General for not safeguarding its workers against COVID-19. The suit says employees were forced to work under unsafe conditions. Those who voiced concerns were fired, and the company continues to make billions during the pandemic. On the earnings front, Daimler this morning published an 11% drop in quarterly revenues, but earnings rose 53% to €339 per share. Nestle sales dropped 8.9% year-on-year. Airbus revenues plunged 23%, and Credit Suisse dropped 22% in net profits for Q4. All this as China's Baidu revenues increased 5% to about $4.69 billion on increased advertising, artificial intelligence, and cloud services. Its streaming services, however, are losing out to Tencent and Alibaba's Youku. Barclays this morning reported a 38% drop in profits, but it'll resume paying 1 penny dividends, and Plus 500 reported a 4% decline in revenues year-on-year for the quarter, but a 146% increase for the entire 12-month period. This as it launches a new share buyback program. Walmart will be reporting today alongside Marriott, Dropbox, TripAdvisor, and Fiverr. Well, sorry if you experienced some of my upload speed hitches today. Please come back tomorrow as we close the week. Bye.